All right, so check, radio check. I want to thank everybody for taking time out of their busy schedules. I was away last week. If you've not been on this call before, typically it's 15 to 30 minutes. We speak on different topics. I know anybody that has brokerage statements, 401ks, IRAs. I was just on a call with a client yesterday, and we had done an annual review earlier in the year, and part of their offerings from their employer were stocks and restricted stock units. And I was shocked to see the account had been cut in half just from a valuation standpoint. So the markets are very volatile right now. But I also, part of the reason that I like to do these calls is part of, I feel, what we have to do is we have to have presence of mind. We have to try and, as much as possible, remove emotions from it. The sky is not falling, right? Markets have been through turbulent times before. They will be through them again. We are heading into, and as I mentioned earlier this year, that the third and fourth quarter of 2022 will be a challenge for a lot of investors. That being said, I think you're starting to see the signs of that sort of got popped off in August. So without further ado, I'm going to take us through these slides. And then I do think that if you're in a 401k or an IRA, I would encourage you to start coming up with some strategies that can help you to weather the storm. But one of the interesting points, like I said, I was on the phone with the client yesterday, and the one 401k, they had given me half their money and the other half they had left in. What they realized was that they had been continuing to contribute into that. So it looked like it was probably higher than it would have been because they kept adding money and they were getting a match. So that you always want to do up into the match, but maybe above that, we have to start to rethink and what to do. So what's the data tell? So remember, this is equities, right? Growth markets, broadcast indices, and there's for 1 month, August. Now, August started out really well. And I think the S&P was on point to be up almost 5% for the year. But as you can see, by the end, everything was below zero, right? And, so pink is your emerging markets. I call that China. The gold is commodities. I think this orange color one is the Dow Jones Industrial. This blue one is the Russell 2000, and this purple is the S&P. And then we have the two greens here. You have European markets and real estate. So, well, what's this look like on the annual basis? Well, this is why everybody's feeling the pain, right? So since beginning of the year, it's just been a steady trend downward, anywhere from 12 to 19%. The only thing that seems to be doing okay are commodities, and even that has started a sideways trend. And, with inflation now being the topic every day, whether we're hearing it on the news, whether you're experiencing firsthand when you're buying an item, the Fed has made it really clear that they are looking to curb and stem inflation. Markets be damned. So you're going to see here the equity markets, that's going to be a challenge. If people stop buying cars, the price of goods go up, it will bring this economy, which has already been resilient, but has shown signs of slowing. We have 2 consecutive negative GDPs. Technically, it could be a simplified version of a recession. They're not going to call it a recession right now, but the signs are there. And so you have to trust your instinct and go, are you better off today than you were a year ago, 2 years ago? And if your accounts aren't reflective of that, you got to say, these items, right? If I'm not buying as many of the items that I used to buy, going out as often as I used to go out, that will have a trickle effect through the economy, and all the companies that support these different industries will become or be under pressure. So, instead of me sitting here reading you which one did better, they're all just ugly, right? And I don't have a crystal ball. I just know that The way that I explain this is that there are headwinds. Remember, I talk about headwinds. If we're in a plane and we're trying to get to California and the pilot knows, hey, we're going to have some turbulence up ahead, keep your seatbelts on. That's the same advice I'm giving you right now. Turbulence is ahead. You can't get out of the market, because if you get out of the market completely without a strategy to get back in, right, then what have you really accomplished, right? You may have missed some of the upticks. I think that, when information comes in, like the Fed raising rates, the market has typically built that in, it adjusts, and then it will continue to try and move forward. So we're going to continue to see some volatile times, but I do believe in the equity markets. I do believe in the US economy. We will get through this. If you don't need the money tomorrow, then you need to continue to keep putting it in to work, but in which environment, right? So like I said, if you're at work and you have your 401k and they're matching and you're able to continue to contribute, set it, be consistent. Repetition will pay you dividends into the future. Does that mean that the accounts can't go down? Absolutely not. They can. And I think a lot of you have experienced that. Again, this is not a pretty sight. We have a red line on. I think we've peaked out here. I would venture to say that we will continue to see downward pressure for a while. But even when we have drop-offs, like what we had during 2008 or 2001, right? Even when we had a flash crash in 2016 or when COVID hit, right? They did rebound. This is a little bit more steep and more of a rounding here. So we could still see some downward pressure. But my belief system is eventually that these indicators will show and turn around. And then when we have those rallies, you've got to make sure that they're in it, because they've done studies where people get out at the wrong time, they get in at the wrong time, they let emotions make their decisions, and they miss these upward pops. So just be aware that if you decide that, hey, listen, I can't stomach this anymore. I'm 64 years old and I'm retiring next year, and I can't lose 20% of my retirement to this nonsense. Well, then that's a valid concern, and you should be talking to a financial professional to be able to make that adjustment, because there are tools that you can do to help to protect that. But as we get older and as we move through this journey we call life, we have to have options. We can't just always just go, okay, everything's going to be fine, and then we find out later on that we were talking to our next door neighbor, we were talking to the person in the cubicle next to us, they gave us financial advice which wasn't really sound. Now let's look at the income. Again, if you're on a fixed income budget right now, it's not been friendly for you. But what I will say, even though the month of August was off, for the year to date, it's off, right? So it's just, this makes it hard when you retired, you told you were going to be in a safe light vehicles because everybody thought bonds were safe. And, I've talked about this before, bonds and bond funds don't like rising interest rates. However, right, I think that we will start to see, as these rising interest rates start to come in, some of these coupons that some of these bonds start to pay income portfolios in the future for new purchases will start to increase. So although the values are down, right, there are opportunities. But again, I'm steering clear my clients of the bond market. I think you need to put other things in place. I just got back from Vegas, our investment advisory firm, and structured notes. And one of the things I think I'm going to do a call on are something called buffered ETFs, right? So just different strategies that are not without risk, but I think they really do minimize a lot of the risk. I just went over with my office yesterday, structured notes for the month of September, right? My philosophy is, let's take some of these notes, instead of doing a 60-40 split with 40% into bonds, let's do 40% into notes and start to get these above average coupon rates to offset some of the risk or some of the volatility in the equity side. That seems to be working well. It doesn't mean that my accounts aren't down either, but they're recouping some of those losses. And as they turn around, and because we're not making emotional decisions to get out from the equities, we're still positioned to capture the upside. But on the bond side, we're getting these coupons to help replace some of the losses that have happened so far. So that's one strategy. I absolutely also believe that with rising interest rates, a lot of the annuities that companies are offering now, fixed index annuities and MYGAs, are offering places for safe money at, rates that we haven't seen in 5 to 10 years. Right. So, I'm saying short-term rates of 3 and 4%, where CDs at banks are, 0.5%, maybe you see 2% now. We're getting full points, 2 points higher for shorter terms than the banks are offering. So there are options. So you should really consider and look at that and see what else is available. So again, this is our chart. We're seeing that mountain theme here. So again, this here is when this went off. Now that red line triggered, I think it was right here, and this is an older slide. So we're still in a red downward spiral pressure here with the bonds. This needs to get put back in there. I'll talk to Mark about that. But we're I think I'm staying away from bonds right now, as I just mentioned. So the last slide is something called a recession probability analytics tool. And this tool is just a series of data points. There's about 100 pieces of information. What is new housing starts? What is commodities? What is unemployment rates, right? GDP, all these things are put into these algorithms and it spits out a number. And what do we see as recession, 50 being the median, right? Last month, July, right? June, July, we were just over the 50 percentile where we had been. We were running along pretty smooth, and then things have started to heat up. It did fall back. So we're at, I think this number now is 43 right now. So it was at 52 and now we're at 43. So there's a little bit of a swing, but I do think the next time we show this slide, we'll be back above 50. It's just, nobody wants to say the R word. Nobody, it's not good politically, right? I'm not a doom and gloom type of guy, but we do have to go into it with our eyes open. If you drive in a tunnel and see your lights and close your eyes, right? Hopefully that's the end of the tunnel and it's you're not getting hit by a train, right? So you have to know what's coming, because it is okay sometimes to sit on the sidelines. It is okay if you're, and this is some of the conversations I have with my clients. If you're going to say, hey, I want to get out of the market, I tap out, okay? I want out. Okay, we can do that. Emotions, put that all to the side. But what is our re-entry strategy? Why we have clear, cool heads, why we're not being emotionally driven. What can we do to say, hey, let's get out? Because I think that things are, the market's down 30%, 40%, 50%. I can't stomach it anymore. Okay. What's your plan to get back in? Because if you don't go into it with those thoughts, it makes it very difficult for re-entry, right? How are we going to go back in? And you got out at the wrong time. You sold when it was low, and now the market came back and you missed the upside. So that's the part where talking through and sort of strategically figuring out a way to either A, exit the market, or B, re-enter the market, I think is helpful. This is just our disclaimer and disclosure and notes for my RWA, which is my my compliance and all that stuff. And then, if you have any questions, reach out. I really do understand and like helping people. There's a lot of opportunity out there with some different strategies that a lot of people may not have insight on or access to. So if you have any questions, you'd like to learn more, happy to help. Other than that, I want to wish all of you have a great day, and thanks for showing up. How'd I do? I'll see you all soon, and just reach out. My phone number 732-302-1810. Bye-bye.